If you spend any time looking into day trading, you will hit the same statistic. 95% of retail traders fail. There is no scientific study, academic paper, or empirical dataset that actually proves that specific failure rate. Trading influencers and course sellers frequently cite that number to generate fear, establishing a problem they can solve with an expensive algorithmic course or a secret chart indicator. If the failure rate is exaggerated and those expensive chart patterns don't automatically print money, we have to look at why retail traders actually drain their accounts. This chart shows a sharp downward plunge in the white trend line. Traditional technical analysis assumes markets move rationally, but it fails to account for irrational human behavior during periods of extreme stress. Retail trading failure is driven by biological impulses that technical charts were never designed to manage. Behavioral finance combines economics and psychology to show that human brains, evolved for survival in the wild, are poorly suited for making probabilistic trading decisions. This biological blind spot was formally mapped out by Daniel Kahneman and Amos Tversky in a framework called prospect theory. Prospect theory identifies a specific cognitive bias known as loss aversion. Mathematical studies of loss aversion show the psychological pain of losing money is twice as intense as the pleasure of gaining the exact same amount. This emotional asymmetry completely dwarfs the positive gain scale, warping an untrained brain's ability to calculate risk-to-reward ratios objectively. Because we are biologically programmed to avoid pain at all costs, our financial judgment becomes compromised the second our own capital is put at risk. In live markets, loss aversion creates the ultimate account killer, the disposition effect. Amateurs panic sell early profits for a quick dopamine hit, missing the upward trend. But during a plummet, the exit point keeps getting pushed back to avoid pain. Trapped by the sunk cost fallacy, they blindly hope for a bounce instead of logically cutting the loss. They tell themselves it's just a dip. The market has to recover. They'll sell the second they break even. By succumbing to the disposition effect, traders invert the golden rule of investing. They cut their winning trades short and let their losers run until the account is empty. Compare that amateur behavior to the actual data from elite professional day traders. At the top levels of finance, the most successful professionals rarely win more than 50% of their total trades. It is a statistical reality that profitable traders often lose more individual trades than they win. This side-by-side bar chart comparison shows an amateur portfolio against a professional one. The amateur has many tiny green wins and one massive red loss, while the professional portfolio shows many tiny red losses and one massive green win. Looking at the professionals' tiny red bars, we see how they keep their losses small by strictly bypassing the disposition effect. Limiting the size of each loss ensures that even a moderate win rate generates a massive net profit. A professional's edge is built on emotional regulation and strict adherence to risk parameters. The market is not inherently rigged against you, but no technical strategy will save your portfolio until you master your own psychology, cognitive biases, and ego.